This is the moment where farmers can get caught on the wrong side of the market, because while prices don't look that different today, the cost of putting a crop in the ground just changed. Oil just surged, fertilizer risk is coming back fast, and the market hasn't reacted yet. That's the problem. Because if farmers start adjusting acres based on margin instead of price, this market won't ease into it. It'll move fast, and it'll leave people behind. So the question right now is, are we about to see the first real acreage shift of the year before the board even shows it? And I'll get into the markets here in just a minute. But first, you need to understand what's changing underneath them. This is Boots and Bushels, your daily look at the markets that feed America. Today we're breaking down the sudden return of input cost pressure, what the government just did to try and stay ahead of it, why fertilizer risk is building again, whether that could quietly stack on top of everything else, and what all of this could change for planting decisions. Because right now, this isn't just about price, it's about positioning. Let's get into it. First thing that should get your attention today is what just came out of Washington. The government temporarily waived the Jones Act. Now on the surface, that sounds like policy noise, but it's not. This is a signal. This move is designed to speed up the movement of fuel and fertilizer across the United States, which tells you something important right away. There's concern about supply tightness building faster than expected. This isn't proactive, this is reactive. They're trying to move product faster before it becomes a bigger issue. But here's where you need to think one layer deeper. This doesn't create supply. It doesn't lower global prices. It doesn't change what's happening overseas. All it does is help move what's already available more efficiently. So if the underlying pressure continues, this move doesn't fix the problem. It just buys time. And the risk here is simple. If supply doesn't improve quickly, the market will start pricing in higher input costs, whether policymakers want it or not. When that happens, the impact shows up fast, not in headlines, but in margins. Now layer this on top of fertilizer pressure is starting to build again. It is coming from multiple directions at once. You've got global supply concerns, you've got policy constraints, and now you've got growing calls from ag groups pushing for import relief. Because the system is tightening, and when fertilizer markets tighten, they don't move slowly, they move in steps. And those steps tend to come at the worst possible time, which is exactly where we are right now, right before planting. Now here's the part that matters most at the farm level. A lot of producers did not fully lock in inputs earlier this year. Some did, but not everyone. Which means this isn't just a background story. This is an active pressure point, right now. And when fertilizer costs start moving higher, this close to planting, it forces a shift in thinking. Because suddenly, you're not just asking, what yield can I get? You're asking, what crop protects my margin if costs keep climbing? That's a completely different decision. And that's where markets can get caught off guard. Because acreage doesn't have to shift dramatically to move price. It just has to shift enough. Now let's talk weather. Because this is another piece that doesn't look extreme yet, but it's leaning in a direction that matters. We've still got snow hanging around parts of the Midwest, which slows early fieldwork. At the same time, you've got early heat building across the plains and western regions, temperatures pushing into the 80s, even 90s in some areas. When you combine that with early dryness, it starts to raise questions. Not about today, but about what comes next, because this type of setup tends to evolve. It doesn't stay neutral. It either breaks wetter or it turns into early season stress. And right now, there's areas where moisture isn't building the way you'd want to see it. So what traders are watching is simple. Does this pattern start to threaten early crop conditions? Because if it does, now you've got a second layer of risk, stacking on top of the input costs. And when risks stack, markets move faster, not slower. Now let's step back and look at everything we just talked about. You've got rising energy costs, building fertilizer pressure, weather uncertainty starting to develop, policy reacting instead of leading. And yet, the market hasn't fully responded. That's the disconnect, because right now, there's a gap between what's happening underneath the market and what's showing up on the board. And those gaps don't last. Eventually, price catches up to reality, or reality backs off. But one of those things has to give, and right now, the pressure is building on the reality side. not the price side. Alright, now let's look at where things are trading. Crude oil is trading near 94.51, sharply higher. That's your starting point. That's what's driving everything else underneath the surface. Corn trading near 4.53, under pressure. Soybeans near 12.14, holding some strength. Wheat trading near 5.95, mixed. Oats weaker, near 3.59. Lean hogs around 93.57, softer. Feeder cattle are near $355.03, basically flat. Live cattle near $233.28, still holding firm. And sunflower oil moving higher as well. Now here's what matters. Energy is moving aggressively higher. Input risks are building, but grains have not fully reacted. That's the setup. When you see that kind of divergence, you need to pay attention because markets don't stay out of alignment for long. Now let's bring this back to the decision that actually matters, corn versus soybeans, because this is where everything we've talked about starts to come together. Corn is input heavy. Fertilizer matters more. Fuel matters more. Operational costs matter more. Soybeans, less so. So when input costs start rising, even if prices don't move yet, the relative math starts to change, quietly. And that's where acreage decisions begin to shift. Not all at once, not in a headline, but one field at a time, one farm at a time. And if enough of those decisions start leaning at the same direction, that's when the market reacts, not before, after. And by then, the move is already happening. Now on the livestock side, things look steady on the surface. Cattle holding strong, feeders flat, hogs slightly weaker. But don't ignore what's underneath here either. Because higher feed costs, higher fuel, higher operational expenses eventually work their way into livestock margins as well. It doesn't hit all at once, but it builds. And if grain markets start adjusting higher, that's where the pressure point starts to show up. So here's where we are today. This is not a panic moment. This is not a confirmed shift, but it is a warning. Because the structure underneath the market is starting to change. And when that happens, the biggest moves don't come from what already happened. They come from what's about to. So the real question right now is, do input costs force a different acreage decision? Because if they do, this market won't wait around for confirmation. It will move, and it will move fast. That's today's Boots and Bushels. If you want daily updates on the markets that feed America, make sure you're subscribed. Because right now, the biggest risk isn't what you see on the board. It's what's building underneath it. We'll see you tomorrow.